Let's get started and make sure I am sharing the right screen. Looks good to me. Thank you very much. Go to webinar. Let me bring you here. So we're going to do a bit of charts, go back and forth from charts and slides this evening. Thank you for joining me. Before we get started, has the government closed yet? Are the Americans still operating? What's happening over there? It is a bit of a non-news. It's fun, it's interesting, but actually, I think, was it 2018, 2019, the government shut down for 30 odd days or something. It was over the border wall, and markets rallied. I think it was over Christmas anyway, so there's probably a bit of a Santa Claus rally effect there, and they're more interested in what Powell was doing. But the markets rallied, and I think they did the last time in 19, wherever it was. So it's I don't think it's something to be concerned about, generally speaking, but it's a good news story anyway. The markets don't care unless it turns into something more substantial. It's feasible, I guess. But you know what's happening today, markets chopping around, end of quarter. That's all they care about, really. They don't really care about this. So who knows what's going to happen? It's interesting to see, isn't it, when you've got politicians trying to agree on something. It's never going to end well. Anyway, this evening, guys, what's going on? Let's look at the markets. Not a lot. It's choppy. End of the month, end of the quarter. Maybe the last hour we'll have some window dressing, some shenanigans going on, but it's been a bit of a chop fest. NASDAQ has, especially today. I'm looking at the other screen here, down $50 or so at the moment. Dow down 100. S&P down a smidge. You know, this is all shrapnel. It's nothing to be excited about. Gold was down. It's now kind of clawing its way back up on its big bull run of the day, of the week, of the month, should I say. Platinum's got my attention. Don't normally trade platinum, but it's been on an absolute tear. I think that was to do with the Chinese being a bit more green. Can the Chinese be more green? They were a bit more green, and so precious metals, platinum used in that type of stuff, got a bit of a bid. So watching that, it's pulling back today. Is there a trade there? Maybe. Keep my eye on it. I'm not going to be super excited about it. Anyway, let's get started. Today we're talking about the Trapped Traders Playbook. So one of my more preferred strategies, playbooks. It's got a big role in my trading. It probably has in yours without realizing it. Maybe you use it to a certain extent. We're going to go through some of the I'm going to go through the charts in a moment, look at some examples, see my scribbles and stuff on there, and really run through how to kind of build, without getting ahead of myself, how to build not necessarily a full playbook, but incorporate understanding how other traders are trapped. There are three kind of main ways, and we're trying to perceive who's on the other side of our trade. And this was a great quote from Galen Hall. I think you pronounce it Galen. And this was in an email I sent out the other day from a YouTube video, a Bloomberg's original YouTube video, and it basically said, it was just beautiful. It was a beautiful line. In our fund, every strategy we run has a specific player in the market we believe we're making money off of. That was a transcript, so it's not kind of wrapped up in a nice, succinct way, but it was literally part of the literally he said that. If you go to YouTube, Bloomberg's original, type in poker fund, and it's in there, and it kind of an interview was talking about some hedge fund managers, and this guy said this thing, and I thought, you know what, that is such a good line to kind of read as a North Star. He's running a hedge fund and he's thinking about that. As traders, we should be thinking about, hey, who's on the side of our trade? Last week we talked about, I'm just scanning back here, candlestick patterns for the modern market, and a lot of that was kind of driven around understanding and digging into and thinking clearly about who are the participants that matter, the buyers who haven't yet bought, the buyers who are buying steadily over the day, the buyers who are perhaps trapped, the shorts who are sitting on the sidelines. That mental gymnastics, mental arithmetic, if you like, of considering who's the other side, who's a counterpart to your trade. Why should the trade go up after you bought? And this is kind of just adds extra color to one of the better playbooks, or one of the better strategies, I believe, when we're kind of working out if traders are trapped. Because if a trader has an incentive other than trying to make money from the market, that is how we can capitalize. And just like Galen Hall was saying, if there is somebody who is wrong, who is stuck, who is trying to limit damage, they are going to be inefficient. I don't believe your markets are efficient anyway, nor really do you, because you wouldn't be here, right? That's our edge. But just understanding, hang on a second, if someone is acting with a sense of urgency, if we believe someone is panicking, if we believe someone has to get out, and I always talk about time sensitivity versus price sensitivity, they need to get out now versus getting out the best price, there's edge there. And the bigger that edge, the more we can take advantage of it, especially as kind of retail traders like us who don't have HFT edge. Do you think about HFTs, not to go off on a tangent, but high frequency trading, a lot of that algos and stuff, they work out at the edge from market orders, from stop orders, which are market orders, or from market orders. They kind of see that, they can move the price, they get front look and early look and all that type of stuff. That was the whole Flash Boys thing. I don't know if I've got the book up there anymore. There was edge. When someone doesn't care about a certain price movement, then there's edge. Now we can't compete against a tick or a few ticks. Like we, if we're getting stopped out or if we're getting a market order, we don't care if it's at 50 or 51. We'd like it to be 50, but if we're getting stopped out, we should be stopped out. Same with the trap traders. They ultimately don't care. They have where they get out. They just need to get out. But we can use that to our advantage, and that's where our edge lies. Always be thinking about where's your edge. Do we have an informational edge? Very rarely. Maybe you do on some small cap stuff. Do you have an Nasdaq? Of course you don't. Do you have in dollar? Of course you don't. No one does. But do we have kind of edge where there are participants who are perhaps acting irrationally that we can capitalize on? I believe so. So that's what we're going to talk about today. Long-winded introduction, but hopefully, you can see where we're going with this. Let me make sure I have everything lined up. So that's a great quote from Galen Hall there. All right, let's get to the disclaimer. Quick introduction, then we'll get rolling. Then we'll go to the charts. Then we'll come back and we'll keep things moving. Hopefully, by the end of this, you will have some really good ideas on how to incorporate this kind of trap trader mentality into your trading. By the way, we don't know for sure. Sometimes we do. There'll be some parameters there. Some of the scenarios that we do know for sure. But often we're making an educated guess, but we're doing that anyway, trading. Right. So anyway, risk disclaimer, please, ladies and gents, however you are trading, whether you're trading spread bet, CFD product, or anything else, especially if we're trading with leverage or margin, know the game, rules of the game, understand that double-edged sword works well, fantastic when you're on the right side of the market, can get nasty very, very quickly. When you are not, you don't want to be a deer in headlights. If you're leveraged up, things are going against you, you're not using risk management, that's a recipe for disaster. So don't get into that position. Understand how leverage works, keep it small, keep your risk managed. I know I say it all the time, please do. That small size, using stops, recognizing the risk you can control, the risk you can't. In other words, during the trading day, you can put a stop in, you can trade small, you can trade thick liquid instruments, not trade over news. That's risk management. Now, if you're holding bigger positions over the weekend, this type of stuff, when there's news out, you give up control of risk, and especially leveraged up, things can go hair-shaped and south very, very quickly. So, of course, please understand the risks involved in trading before you risk a penny. A brief introduction. My name is Mark Holstead. I run Traders Mastermind. I've been trading since 2001, probably 2002-3 seriously, but started dabbling then. And that's all I've ever done. And if you want to join my daily email list, you can do. It is tradersmastermind.com, free to join. I send out an email out every day. Enough of that. Let's get down to it. We've got a lot of charts to cover, a lot of ground to cover today. Let's keep it moving. And we've got the lights on. It's in the UK, and we're starting to get a little bit dark. When it starts to get a bit dark on the webinar schedule, we do these every week, by the way, 6 o'clock UK time. I know that winter's coming. Winter is coming. But that doesn't mean that the markets are not a pleasure to trade, unlike sometimes in the summer. Okay, so what does trap mean? Let's sort of get the definition out there. Traders forced to act under pressure. As I said, they've got another incentive other than making money. And that's, think about how to frame that in your mind. If you have a stop loss, your incentive is to get out of the trade quickly. You just want out. You want to stop the loss, no more. You don't particularly care. You'd obviously like the best fill possible, but if you get slipped, it's part of the game. Slippage happens during stops, fast market. That's what a market order is. Think about that on a bigger scale. You're being forced to make a decision when you're acting under pressure. Maybe you've been wrong-footed by price action. Maybe you have a line in the sand that breaks and you have to come out of it. That could be, by the way, an actual stop, or it could be, we're talking about bigger funds and bigger money. They don't have a stop just sitting there that just goes ping, liquidate my, billion worth of assets and put it in market. Of course not, because that's going to send the market into a frenzy, lock it up, all sorts. They have to work the position, and how aggressive they are at working that position depends on how incentivized they are at getting out now. I know for a fact that some of the algorithms that these institutions use have various settings on that they can up and down the aggression. Either it's the kind of a machine learning that sometimes will do that automatically. More liquidity, they'll become more aggressive. Less liquidity, they won't. But there's also a user setting like, hey, work this order as quickly as possible. And we see that quite a lot, not recently, but if you see markets panicking and markets kind of falling through the floor, that is a lot of sell algos saying, hey, we need to be more aggressive. Get this done now. In other words, hit bids, hit bids. There's 2 in there, take it. There's 20 in there, take it. Whereas someone who's a bit more measured, an algorithm that's a bit more measured, will be like, hey, don't hit the bid unless it suddenly flashes up at a 50 lot or 100 lot or whatever it might be. We're not hitting bids, we're working offers, stepping down. We're being a bit more passive with our approach. And so, I wanted to think about this as not just necessarily a stop being triggered, but a stop might be, hey, we need to liquidate and we need to do it with some pace. And that what causes the market to move. Think about the internal dynamics of the market, the bids, the offers. When the offer gets hit, the offer gets lifted, price takes its place. That's how trades operate. That's how trades execute. That's what we see on the print. So just having that in your mind as we kind of go through today. So why does this matter, right? I've said this, so let's reframe it from a slightly different angle of attack here. When someone is forced to exit, that is going to have urgency. Now, one person forced to exit, no one gives a toss, who cares, right? When you have a group of people, and we'll show how to identify that group in a moment, and we'll get some charts up and we'll do all the kind of visual stuff. We know that that batch of volume potentially, again, there's a lot of kind of guesswork here, but trading is like that. We don't necessarily know for sure. And the only time we knew, there's times when we've known for sure, or not necessarily we have, but our opponents have. If you think of the guys, the rogue traders, and it got out. So Nick Leeson was one, Jerome, I've forgotten his surname, Frenchman, and then we had Kwaku Adeboli, I think his name was. They were rogue traders who went rogue. There's kind of articles on that if you want to read that. I'll put them on the website. But they were super interesting, right? Because word got out that these guys had taken on erroneous positions in the DAX in Jerome's case. I can't remember what Kwaku was trading. And Leeson was trading Nikkei futures. But word got out, especially with Jerome, and the other funds squeezed their hell out of the DAX because they knew there was a big batch of people had to unwind it. And so that was, the knowledge was there. There was an informational edge of, hey, that fund is trapped. They need to get out of a very small door. How can we take advantage of that? It's a ruthless business, boys and girls. That's the way it is. I got another example actually of something similar to that. So sometimes you do have that. We won't probably get that sort of information, but more than likely what we're doing is we're making an informed decision, and we're making an assessment based on the price action, based on some of the news, all the other stuff, and we say, okay, we believe some participants are trapped. That panic is going to like a trigger, I call it a stop, but going back to the point of an algo being more aggressive and trying to get out of the position in a bit more of an expedited manner, for want of a better word. And that is the opportunity for us. That's when we can ride the momentum. That's when we can use that, preempt it, play the game of chess. If this happens, then that happens. I think that could be a trap trigger. I want to trade that as an intraday trader, as a swing trader, whatever you might be. I want to take advantage of that. And that is, I think there's edge there. Is it all the time? No. Is it something you can do every day? No. But it's definitely a layer to, I think, to add into your existing playbook. I have strategies and playbooks that sit just around the trap trader idea. And I've also got playbooks and strategies that have that as an extra filter. If this has happened beforehand and a precursor for this pattern, then going a little bit heavier, you can take a little bit more risk on that. We'll go into that in more detail in a moment. Okay, so the psychology of the trap. So sometimes we have this scenario where, the little image there, everyone trying to get out of a very small door. There was someone who did a really good animation, actually, just perfect. There's like loads of sheep in a pen, and everyone was coming in to eat food and thinking it was like free. It was sheep. Now I'm butchering this because you can't see it visually. And then all of a sudden it was like they had to get out, and everyone's trying to get out of a very small door. And of course, that just causes a lot of pressure. So, FOMO in, panic out. And the psychology is often, hey, these aren't people who are in profit. These aren't traders who are in profit, banking profits in a relaxed manner. Just think of yourself. Now, we may not be institutions, but institutions, large money, it's human, right? If you are sitting on a large unrealized P&L, and the market starts to back off, let's say you're long, it starts to back off and you're unwinding the position, okay, maybe there's a sense of urgency there. There's no panic, right? You're not really thinking, oh God, I'm going to let you just, you see unrealized P&L dipping away. And the bigger the cushion, the less concerned you are, right? It's kind of coming back. You're up 4K. It's coming back a couple of £100, £100. Yeah, it's no big deal. You say, okay, would have been nice to be out of the high water mark, but I'm not. So there's no panic. Versus market's kind of falling through the floor. You haven't got to stop, God forbid. But let's say I've got to stop. You're now down that amount, and you just see it getting worse and worse and worse. What's the difference in thinking? The difference in thinking is get me out now because this is bleeding fast. I see 4, 4.5, 4.8, 5, 6, whatever the numbers might be for you. 60 quid, 6 grand, doesn't matter. It's the same principle of, hey, this is stinging. The same applies for a fund, for institution, slightly different, of course. They're a little bit more robust, but they still don't want to lose a lot of money, right? And there's that slight difference in urgency when people are trying to get in or out. It's like when we see heavy down days in the market, right? Majority of people are invested in assets that go up. They're invested in stocks, invested in mutual funds, index funds, and the majority of hedge funds are long. And so when things start to go south, and they go south very quickly, there's a panic of protecting what we have. Oh dear, we are coming up to year end, quarter end, month end. We've got bonuses. We've just ordered the new Aston Martin. We've just ordered the new Ferrari. We've just bought a new house. We just bought a lake house. Oh, our bonuses aren't going to be that. I'm exaggerating. We need to get out quickly. The fund is in trouble. The fund doesn't want to put this kind of number up. I want to put a decent number up. You get the idea. So pain, confusion, forced exit, trap traders, and that equals fuel for the other side, us. We want to be on the side of that trade. We want to be seeing the trap. We want to be using the trap to our advantage. Okay, so 3 types of traps that I look at. There are probably more, and it's just the way that I frame it. Not saying I know everything and I'm right, but it's just the way that I like to box it off in my mind when I'm coming up with the playbooks, or when I'm adding this is a positive, like a green flag, if you like, to an existing strategy or setup. I kind of go, okay, which one is this? Is it an intraday trap, event-driven trap, or broader positioning trap? So let's explain what they mean, and maybe you can use this framework yourself, or maybe you can kind of take bits from it. You know, absolutely fine. However you choose to use this or not is entirely up to you. It's your trade, it's your money, it's your trading approach. You know, I don't, even though I've got a couple of decades experience, I don't stand there and say, hey, I know everything, do exactly what I say. Absolutely not. Hopefully this will give you some ideas and some seeds to put in your brain and kind of grow from there. And that's always the best way, by the way. If you come up with an idea and you hear an idea in a strategy or a framework, is to say, that's interesting. I'll take that, but I'll also run with it myself. I'll explore, and I'll give you kind of something at the end of the webinar to some directions to maybe go and explore some things for yourself and say, okay, that makes sense. So if this makes sense, what I'm trying to say is, if this makes sense as we're going through it, write some notes. At the end of it, you can go, right, don't just forget about it. Say, I'm going to explore this. I'm not interested in this. I'll explore this. Okay, back on track. So intraday trap. So the theory of this, right? The theory of this is, and by the way, I call it intraday traps. This is my naming convention. It can really apply to a daily chart. So confusing as hell, given, but it's the way that I think of it. It's like it's maybe it's a pattern trap is probably a better way, but I've named it this for ages. It's been like this for ages. This is what I'm calling it, right? So the theory of this is that you've kind of got some pattern intraday or multi-days, or spanning over a few days, or a daily chart, whatever it might be. Examples in a moment. That really is just obviously catching traders out. It's we've talked about bull trap. Well, we haven't talked about it, but you've probably heard the phrase bull trap, bear trap, shorting into the hole, this type of stuff, and they're banded around quite loosely. And there's a distinction between, again, charts in a moment, the distinction between kind of a genuine pattern like a pin bar, a spring, or what have you, which is just a liquidity looking around, auction process. Price starts to do a bit of discovery to the downside, doesn't really bring any more supply in. Now demand steps in. That's very different, in my opinion, to an actual trap. And I say we'll look at some kind of examples to see this. But a trap is when we have a lot of people going in one direction, and then that direction changes. Example, opening drive failure, VWAP reclaim to a certain extent, more like a failed breakout or breakdown. That could be on a multi-day level gets broken, a lot of business gets done on one side, a lot of volume comes in. We'll talk about volume in a moment. Volume comes in, participants come in thinking they're right, thinking they're correct. That changes very, very quickly. That cluster of volume that was done under that low, whether it was a whole day, half a day, you've got to have some volume in there, otherwise it's not trap, right? It just dips under very, very quickly and pops back up. Fine, there's still information, but it's not a trap because you've done a couple of thousand contracts or whatever, if you're watching the futures or whatever it might be. But there's a whole day, loads of price action under, then rallies back up in the afternoon. You've got thousands and thousands and thousands and not millions, depending on what you're doing, of participants or volume that maybe was expecting a move lower and has now got to reposition. And the idea that that volume there has now got to come back in and buy. Not all, of course not. Some people should be coming out of position, but some people will be initiating a short, or some people will be coming out a long, they have to rebuy. And so you think, hang on a second, not only have I got the actual new participants who are buying and are coming in and bringing in demand, I've now got this pent up demand. I can almost take a reading of how much that is and expect that to be applied. So the sense of urgency picks up. Kind of visually in the moment, hopefully it'll make sense. So intraday traps, that's kind of the first naming convention, or first type of trap, if you like. So second type of trap is what I call an event-driven trap. So this is when people are reacting to some kind of news, economic data, NFP, FOMC, CPI, could be earnings if you're trading stocks. It could be kind of general macro news, right? Anything that has potentially or people perceive as a reprice scenario. And what I mean by a reprice scenario is, I guess a simple way to look at it is like, okay, well, if you've got a company trading at, and this could apply obviously for an index, or it could apply to an exchange rate, it could apply to a commodity. You've got a company trading $50, and that's considered the valuation at that moment in time for the company. That's the market cap. Now all of a sudden they come out and say, hey, we earned this much money last quarter, this is how much profit we made. Now logically you might say, well, actually that company is now worth $60 a share, right? And it's a reprice. And so it's a binary event that makes people change what they perceive as the valuation. Example might be in the commodity market, let's say crude oil, right? All of a sudden something's happened, a refinery's been hit, there's no extra supply, there's an issue with ramping up production. It's slightly different when you've got OPEC and stuff, but simplistic terms, there's the demand for crude, but all of a sudden the supply has changed. That's going to increase the perceived value of crude. The price of crude is going to go up. Same with the market, same with interest rate, etc. It's just some sort of binary event, catalyst, that people perceive has changed the valuation immediately on a very short term of that asset, whether it's a basket of stocks like an index, or whether it's an individual commodity, whether it's exchange rate, whatever it might be, right? So an event-driven trap is traders' response to some kind of event. Remember that one. Again, the final one here is what I call a positioning trap. So this is where we have a lot of people crowded in one direction. And again, examples in a moment, I keep saying that. After this slide, I will bring them up for you. But I kind of want to get the framework out there. So this is when you have a lot of people who are short, and we often see that this in the short float on FinViz. If you look at individual stocks, you can often see this as well in the participation, the commitment of traders report. Jason Shapiro is a big guy for doing that. But you can get it on FinViz as well, that type of thing. You can, if there's a lot of people short, then they have to cover, and you can actually see that as a number, right? I won't dwell on this one too much because I know a lot of people don't trade in this manner, but I kind of want to put everything out there for you. Sentiment extremes, when everyone's kind of super bullish or super bearish, you can get this information. How valid it is, I don't know, but you can see it often as well with the narratives in the headlines. You can see this often with some of the financial media. You can see this if you do your own sort of research in forums, in trading groups, in it's a small sample size, admittedly, depends on what you're trading, but kind of the sentiment. When sentiment's getting really extreme, you know the positioning is probably heavy long or probably heavy short. Hang on a second, does that mean there's an edge there with if these guys get trapped. And that's all we're looking for, is some people to get trapped. And a macro narrative reversal. We had this, a great chart for you in a bit. We had this back in the global financial crisis, the carry trade unwind. Now, I'll explain in a moment, but ultimately, you may not be interested in that per se. Maybe you're a day trader, maybe you're a scalper, but knowing there's a really heavy pressure from people unwinding a position that's hurting is only going to improve your edge. Now, best case scenario, you could ride that for all it's worth. Fantastic. Add to it. Great. Fantastic. Great. Super. You made it. Careful. No swearing on here. You made a load of money. Or you use it as a kind of filter and says, hey, I'm just trading in that direction. People are trapped. I can see this trap unfolding. I'm only day trading from the short side or long side or scalping. You get the idea. So, you know, however you decide to use information, it's just valid and it's really, really useful. Okay. So let's move over now to the charts. So I'm going to look at my other screen. So forgive me if I'm not looking at the camera. So let me change this and let's share some charts. All right. So share something else. That's what I want to do. My window. NQ, we should be trading view. Okay, so I think I've got the right tab up. That's today's tab. Yeah, so I'm drawing some pretty pictures for you guys. You'll be pleased. You're pleased. And you'll probably think, God, I hope he's a better trader than he is an artist. Luckily, I am. Okay, so first one. Let's go through some of these examples. How many have we got here? 1, 2, 3, 4, 5, 6. A few examples. Not crazy. I'm not going to go wild with this, but it's to kind of explain the concept and really visualize it. Some actual charts and some, you know, rough graphics here that look like we've done in Microsoft Paint. So intraday trap fail breakdown. Can we see this? Yes, we can. You know, think of this. I want you to think of the participants, the people on the other side of the trade, the counterparty, the group think here. So let's say it's an hourly chart, right? Candle here, candle here. This chart has, this candle have no wicks. It's amazing. You see, opened at highs, closed at low. You have no wicks at all. Market starts to form a level of support and it starts to break lower. And you get multiple hours where the price has kind of started to do business to the downside, right? Now, this obviously, if you're in a very short range, there's a lot of caveats here and a lot of kind of, like I always talk about context, right? Context is key. You know, if this is a big kind of move on big volume at the end of a kind of a heavy down week, or versus kind of sitting in the middle of a range, there's a lot of difference there. But the fundamental idea is this, right? You've got a lot of people who are shorting into the hole, is the kind of phrase from old trade. They still use it these days. The kids use it these days. I don't know. Shorting into the hole is what we used to call it. And, you know, this is where you've got a lot of participants who are selling in anticipation of a further move lower. And appreciate this is like a perfect example that I've mocked up for you. You have an intraday level that's broken down. Maybe it's driven down hard from an open, starts to do a lot of business, multiple hours below that, which is the volume, the volume, the volume, the volume. And then it changes sentiment immediately, and the speed is the fuel, and then it kind of rips to highs. And this might be like multiple hours, it might be a span over a few days, but just imagine that chart, and real charts in a moment, of lots of participants getting caught on the downside, shorting, and then it very quickly rips up. Now, think for a moment, just pause. If you were long from down there, which there will be, every buyer's got to be a seller, what are you thinking? Great, brilliant. I'll sit with this, see where it goes. I'm right. I made a great call. Got a load of cushion. Let's ride it. Let's see what happens. Add some more. Time's on my side. I'm chilled. If you're short from down there, what are you thinking? You're thinking, oh dear, I need to get out of this. I'm wrong, and it's getting worse by the minute. So think of the participants there. You've got a massive group of people who have traded that volume down there. For every buyer's got to be a seller. Some of them will just be selling a trade they've had. Some of them will just be long-term. So, you know, there's going to be a portion that do not care, but there's also a portion who maybe came out of a long, they need to get back in. So not only they need to cover, so they might just be selling and then now to go back in long. These guys who are kind of managing money, who are trying to outperform the S&P 500 might be trying to be smart here, or they're layering hedges on, they have to come off. Or there's fresh shorts who have come in and thinking, hey, it's going to go to new lows, and it isn't. So think about that. All that volume, let's say it's 50%, I'm making this up, 50% of that volume down there is trapped. That's got to come back in on the buy side. Now, assume some is quick off the mark and gets it on this candle, fine. You've still got a big chunk of buy orders that have to come into the market. Add that to the participants who bought this up, the people on the sidelines who are buyers, you and I who are buyers, not that we're going to move the market, institutions who are buyers, algos driving this, money that's been sitting there now deployed. That's making it worse for the people who are trapped. And so our edge comes from saying, hang on a second, I think there's a bunch of volume that has to buy quickly. And what's the logical outcome of that? The market's going to have upward pressure. Does it always work? No, it doesn't. That's why I manage risk, going back to the initial second slide. But whenever we can identify this and say on balance, the probability is there's a lot of volume that has to buy urgently. I want to be long. Don't know about you, but I want to be long. I want to find a place to get long. I still want to be smart about it. I still want to find it, be structured, because it doesn't mean it's guaranteed, but it's definitely tilting the odds in my favor. And I'm always about stacking layers of edge, right? The setup to get in. People are trapped, end of the month, all this stuff. And you just go, hey, going back to kind of what we talked about last week, just thinking clearly about why is this trade going to work? And that quote at the beginning, always not necessarily that deep, but thinking about, who's on the other side of this trade now? And who's going to buy it after I bought it? Well, the answer's here now if you did this. The answers are in front of you. The answer is, hey, there's fresh buyers who have seen this who are coming in, and there's also a bunch of trap traders who I think are going to have to buy this very quickly, or they're going to be hurting and stinging. That's the person who's going to buy it after I bought it. Great, let's take the trade. And you might get in with something like an opening range breakout. So let's say it was spanned over multiple days. Let's say it kind of rallied in the afternoon, trapped a bunch of traders. You then took it the next day on an opening range breakout trade. Maybe you took a momentum ignition, all these things we've talked about before, an afternoon breakout. This is where you layer in the trap with an existing trigger or an existing strategy or setup and say, hey, trap traders, context is good. I like it. How do I get in? We're not buying blindly. How do I get in with a structured stop, with manageable risk, relevant, decent targets, but I'm using that as fuel and saying, hey, I think I need to get long here. How do I get in long? Okay, or ORB, I do this, I do that. You get the idea. So, that's kind of a rough visual example of an understanding the concept, because a lot of people talk about trap traders, like, oh, it's a bull trap, it's a bear trap, but oftentimes it's not. It's just a little sniff below lows, and you're like, well, who's trapped? Well, 50 lots. Yeah, the 50 lots ain't gonna do jack, right? Now, if you talk about the whole day's worth of volume, now we're cooking. Now we're talking, right? We'll some more examples of that in a moment. Okay, so hopefully you get the idea. So next one is some examples here. Now, this was the Dow, and it was 23rd of September. So the context is not perfect because you're trading against the grain. And in reality, you'd be like, hey, Kate, do I really think that this is going to kind of cascade massively? Probably not. But the idea is here. And so this is a very simple one. There's no complexity here. We've covered these before. Simple example, better ones in a moment. Drive off the open, right? You've got all this volume who's bought this, still buying, maybe not so much here, maybe bought this. We failed on that low, and we'll talk about that kind of trigger in a moment. That's probably people, and let's say this is why context is important, because the portion of people who are trapped in that is less than if we the other way around and it was trapping people to the downside and then ripping, because the trend is continuing. They're like, that probably ain't going to come back for a long time. This is slightly different, but it's here and it's recent, and I'm including it. Is that there's a lot of people who would sit through that and go, yeah, you know what, I'm trapped short term. Well, I don't care, because it's a bull market, it's going up, I'm just investing, my timing was wrong. So it's not quite as powerful as when the context is all lined up, and context is always key. But visually you can see what's happened. People got stuck, came back. I think this is the line in the sand here where you could reasonably go, yeah, you know what, there's probably people trapped. VWAP sort of held, bit of an overshoot. Things look good for there. Then when it fails there, and then when it fails there, you're like, okay, that's probably a lot of fuel for a lot of people who were FOMO into that open. Not going to be massive, not the best trap in the world. Maybe you don't take it, it's not, the context is not right, but you get the idea. This whole volume here is now, anyone who bought from here to here, this whole period is now offside. They might not care as much as some of the traps, but they're still offside. And so this is kind of what we're thinking. Now, back to the point I made a while earlier on, a spring, a Wyckoff spring, what's the guy called it? Liquidity grab. The kids call it liquidity grabs, or Wyckoff, the 1930s OG, called it a spring. That's not a trap, right? Because okay, you could argue with me, and I'd say, okay, fine, maybe there is, but we want volume and participants. And if we're trading a daily chart, and I've got platinum up on it because I'm monitoring, as I mentioned before, not specific trading vehicle that I go to, but this is just a spring, which is valid, but it's different. It needs to be categorized in your playbook differently, right? You can't put this on. I don't think you can put this under the trap category. This is like, hey, price tried to kind of push below the magic 900 level, which had been holding for so long. It went below, a bit of volume was done. The auction process worked out, and actually it resolved the upside. And this is a classic Wyckoff spring that became the momentum for the rally up. Transparency, I didn't trade this, but this is kind of a spring. It's not a trap. And so when we're differentiating between the two, whilst they're both valid, and I like them both, we're not putting in the same category because there's not the same participation and the same amount of people who are caught. Okay, so that was kind of an intraday trap and different spring. Let's talk about the event-driven trap. So we're NFP. Was it last Friday? Yeah, 2 Fridays ago. Anyway, this was the NFP from, I think, a while back, and we get this rally from there. Now, this is, again, is not much volume done, but you can see how this is a good example of event-driven trap. People believe that the NASDAQ 100 is now repriced, and so they have a sense of urgency coming in, and they've bought it quite aggressively right until the opening bell for an hour. Now, I hear you, and the smart of you have spotted this. Obviously, pre-market, the volume is not much, and so is there many people actually trapped? Many participants who are holding long who have to then add that supply into the market? No, but you can see how this is kind of an example of an event-driven trap. There's a lot of participation in one direction that fails in the next direction. And from an execution perspective, I always like to look at it as it comes back through the point where the news changes. So the reprice point. So the point where the data came out, so 130 in this example, could be whatever it was. The market thought, hey, reprice, up we go. And then that reprice was removed. And those people, all those participants were trapped. Like I say, this is probably more fueled by additional participants, higher time frame players coming in as opposed to a trap, but the pattern still remains the same. Okay, so one that I traded many years ago, and I dug it all out the archives. I know that you guys don't trade this type, not many of you trade this type of stuff, but for understanding the logic behind it, right? So this is a 3D printing company. Yeah, who cares? Who knows? Doesn't really matter. But this is a positioning trap. Okay, so a positioning trap is when you have a lot of people who are caught on one side. And I appreciate many of you may not trade stocks, many of you don't trade this stuff, but you might, maybe you look at the commitment of traders, maybe you kind of half look at it if it's kind of swinging one direction or the other, but just understanding, why markets move helps you regardless. Okay, so this is 3D Systems, a huge short flow. It was basically drifting into bankruptcy. They're losing money. The 3D printing boom had gone, or the 3D printing buzz had gone. Everyone's like, 3D what? Yeah. These were debt laden. You could see on FinViz they were completely massive short flow. Loads of institutions pressing the short side. That's a logical thing to do. There's nothing really that was going to save them, apart from a debt restructuring. Surprise debt restructure announcement came out. We've restructured our debt. That basically made them the burn rate was, I think it meant they weren't losing money. Something really like that. They restructured stuff. The interest they were paying has been changed, blah, blah. And so we had this huge short squeeze. And this was a positioning trap. You've heard of short squeezes before. Look at some more in a moment. But that was when the crowd was positioned in one direction. They were like, we have to get out. Oh dear. And especially when you're talking about a thin, illiquid stock like 3D Systems, we need to get out now because we're short from average $10 or whatever. This thing just closed at 20. Oh, this thing's just closed at 30. This, it was a real one-way street. And when you're talking about a very small door, when you've got, someone who's trying to get out of 100 million shares or whatever it might be, and it's doing an average of 4 a day, That's a lot of trade. That's a lot of, you've got to be aggressive. You've got to be hitting offers, hitting offers. You're going to move price. And so this was sort of a classical short squeeze. Sort of same with GameStop. We've seen a little bit of Tesla before. You've heard of short squeezes before, but I wanted to frame it from a perspective of how it helps you, and that's okay. Traders trapped, stock short. Oh dear, we need to get out. We don't care what price. We're now super time sensitive. We're not price sensitive. Let's get out. And when you have a perfect storm, things start to happen. Talking about a perfect storm, years ago, but could easily happen again. And this is where you would use this, I think, as a bias to help you with your trade. And again, the reason I include this is not to say go out and trade this, but it's to help you visualize understand the other participants, their motivations, and how they can affect your trade and how you can get edge from there, because that's the key thing. Okay, so GFC 2008, you've heard of the carry trade. So the carry trade was you borrow in one currency, fund in the other, and things like Aussie yen were kind of a big kind of impacted by this. And basically, for layman's terms, is that a lot of funds were positioned long Australian dollar, short Japanese yen, right? So they're buying this. And so what happened was, as liquidity started to dry up and everyone, the urgency was, I need to sell this position. I need to get out of this position. I've borrowed a load in cheap yen. I've invested in higher yielding assets. I need to get out of it, right? And so that panic caused the trap to, and this was something that went on for ages. You can see on the chart, right? Maybe some of you were trading this. And this was basically like, whoa, everyone is trying to get out of this trade. Everyone knew everyone else was trying to get out of this trade, so they're squeezing the trade. It's a one-way street. We don't get these very often. This was many years ago. But the point is that you can see how powerful traps can be when you know this is a positioning trap. No traders are stuck. Other traders know traders stuck. Traders with more firepower, institutions with more firepower than you or I, know they're stuck. It's a perfect storm. And so this kind of latter half of the year, if you were trading this thing, is you don't try and be smart. You just need to get short, either stay short, maybe there's maybe asking a lot, but you're only shorting, you're using that as bias and saying, how can I time my shorts? Maybe taking 1 day shorts, maybe taking 2 minute shorts, maybe taking 4 day shorts, however you decide to trade it. But you can know that the trap traders is helping your edge. So even if you're looking from an intraday perspective, you're using that as kind of fuel to help you kind of put the odds on your side, right? And this is something else will happen again. 100% it will happen again. If it does, it's not getting your head out of the media and saying there's a lot of people who are stuck. This is going to take a while to unwind. I don't need to be doing anything else but focusing on the fact that I know the other participants are stuck. Okay, this is a fun one. Irrelevant, but fun. Again, in the realms of this trap traders thing. So I've shared this before, but this is mad. This was mad. So basically, Volkswagen, a lot of people shorting VW. Again, coming into the latter part of GFC, thinking Volkswagen not going to sell any Golfs, they're not going to sell any the other thing they do, Passat, whatever the hell the new thing is. No, it's not. It is. What am I trying to think of the Volkswagen? What's the big one? Touaregs. Had to think of it. And not selling these. People were shorting them fine. Hedge funds were thinking this is just a dead duck. All of a sudden, Porsche had been building a stake in VW, and all of a sudden they had control over 75% of the shares. Now, people who were short did the maths and went, oh dear, we actually don't have the volume to cover the short position. We can't get out. There's not enough volume. If everyone tries to cover the short, there isn't no shares to buy because Porsche got them. All of a sudden, these guys were like, oh my God, we need to get out there under pressure as well from the GFC. Maybe they're caught unwinding the bloody carry trade as well. Trapped. This thing absolutely ripped. Volkswagen absolutely just ripped, spiked up, went from like $200, what was it, to $1,000 in a couple of days because of the panic and the trap. That's the, yeah, are we going to trade this? Probably not. Maybe you are. Maybe you get another one of these, you probably won't get one. But highlighting the power of the trap, the power that, and of course it's diluted. Intraday traps is diluted when we get these pattern traps, much more diluted than this. These guys are in fear for being on the hook for obscene losses. So of course there's a sense of urgency. But the sense of urgency still applies whether they've bought the NFP and been wrong-footed, or whether it's you know, they've bought high and it's kind of reversed. So it's the same type of thing. All right, so finally here, S&P 500. This was in June. I cherry picked this for a reason. Most of you are maybe your intraday traders or at least active swing traders. One of the things I think you should be looking for is always looking through the filter of, is there a potential trap here? And the thing is with the trap, it's playing a game of chess, because 9 times out of 10, there's no trap. But I'm always saying, if this thing reverses, this is going to be painful. And I want to be on that side where I'm capitalizing on people getting out quick. You know, and this here was a really busy day, really big, strong drive off the open, same type of pattern that we saw on the YM, right? It tries to hold the VWAP and then you roll over, and I think that's often a very good trigger. Did exactly the same thing, rolled over. By the way, it's 23rd of June, just so you know. This was 23rd of September, so it was not the same day. Very similar pattern, right? Trapped a load of people. The panic came in, massive trap, massive volume, and then trapped them and reversed. We had the massive rally. And so everyone who was trapped, and it's kind of people pulled from pillar to post, and maybe you've been a little bit with it, but keeping cool and calm and saying, man, there's a hell of a lot of people who have sold this massive volume down here. They are stuck short, or they're out and they want to be in, and bang, that was kind of the catalyst actually for a massive rally off that low, massive rally. And I'm not saying you're going to call all of that, but the point is that absolute, and this is how markets work, right? You've got a lot of people there who have, let's say you look at the initial trap, sorry, the secondary trap, which is like people shorting this and panicking out. They're in, they're out, and the actual added extra of like, I was in, I'm now out, I'm now short. Oh my God, I want to get back in. That, you know, you look at that and go, there's a lot of volume that needs to be done. That compounded with people who are capitalizing on the trap traders, that compounded with the people who are observing from afar and saying now's the time to buy, and they're maybe not even caring about the trap or anything like that. They're just coming in and they're the kind of fuel for the market. You now say there's a supply demand imbalance. There's likely to be a supply demand imbalance because I've seen people trapped. I've seen the actual momentum in one direction. I think higher time frame participants have initiated a trend here, so I think they're going to continue. I also think there's a panic element here from people who are stuck and need to buy urgently. I want to get long. It's as simple as that, and that's kind of how we kind of need to think of this. All right, let me switch you guys back over here to this one. Okay. The tab audio, there's nothing in the audio tab. There's nothing in the tab that was audio. Okay, so ways to trade these traps. Let's wrap this up, and I'll take some questions in a moment. So this is kind of how to, we've gone through all this kind of stuff, and yeah, we've got some fun examples, I know, but hey, I like this kind of stuff, and hopefully you can see how it relates to your trading from a kind of multi-day perspective, intraday perspective, categorizing up. So how to trade these. Standalone trigger. So maybe you only trade traps. You know, I've known traders who are just trading traps. Now, you're not going to get many trades, if I'm honest, and you're probably going to see every little thing as a trap. Oh, it's a trap, it's a trap. Not really. You kind of want to have a reasonable kind of litmus test to say that's a trap. Another way is to add weight to an existing strategy, right? I think this is a good way to do it. This is the way that I do both, actually. But if you've already, let's say you like to buy momentum ignition longs, you like to trade the orb, you like to trade whatever it is, but you also think and believe there's some players trapped from an intraday trap, from a positioning trap, then it adds extra weight to the trade and maybe gives you more conviction in it. Maybe you can increase the size, obviously personal choice on that. Maybe you don't trade them at all, but you say, hey, well, I won't trade in the direction where I believe people are trapped. So, you know, if you see that a lot of people are positioned short and the market's rallying, you might be like, well, I'm not going to short this at the very least. Maybe you don't want to join it, but I'm not going to short this. And you're thinking about how the higher time frame bias combines with intraday opportunity. And this is, you know, what we're trying to do, guys. We're trying to be smart traders. We're not trying to do what every other trader, let's be polite, out there is doing, right? That's not going to get us, that's going to get us the results they get, and we know what the results are. The numbers are clear. We have to put them all up. We have to see them. So let's not do what the crowd is doing. Let's think clearly about when we're going to deploy our capital, and how we're going to deploy our capital, I'm not saying this is a holy grail. Of course, it's not. You know, this is going to have just as many losers as you know, other trades, and losers are going to be in there. And you can think like you read the trap, like the one the double, you get double trapped. You might be the one getting trapped. But the point is, I think, is if you're aware of it, your reticular activator will start to look for traps. And if you say, hey, if I see something I perceive as a trap, I can deploy it as part of my playbook, you know, and this is how it folds into it. So one thing I want to kind of really kind of dig into this for a moment, if I may, is you've got to be patient with this. You can't go and say, I think it's a trap. You've got to say, hey, it's a trap if this happens. So very often, I'll give you a kind of an example. If we have, and this, you know, the probability is so low, but I'm always ready. If we have a big uptrend day, and maybe I've traded it, maybe I've not, but I've always got jotted down on my blotter, and it says, if this reverses in the final hour and takes out the low, I am to sell the full allocated size I'm allowed into fresh lows, assuming it's going to close at lows, right? And then there's some nuance to that, right? But the point is, I am saying to myself, if, and how many times this happened? Hardly ever. I want to be prepared because I think it's got a big edge. But that's me saying, if I think a lot of traders are trapped in that trend, it's Friday afternoon, all of a sudden everyone's gone, whoa, something's hit the market, and we've got this bad news come out. It's normally a catalyst, by the way, driven, some sort of unexpected news. And it's a massive rug pull. All that volume is going to be going out to a very small door, watching the clock going, geez, this thing will close in an hour, get it done. It's an example, but you get the point. You always got to be prepared for the trap and always be thinking, this probably won't happen. But if it does, man, the guys are going to be struggling. And I think I can smell some profit, some potential profit there. So wait for the actual confirmation. They'll be selling into fresh eyes going, if this trap's going to be great. No, because 9 times out of 10, they won't. You've got to wait for the actual trap to ping, trap of people. Enter as it kind of comes back through that key point. You're not predicting. Stop is, you know, you want it so that if the trap is no longer valid, right? And I didn't really cover stop as a whole different topic. Maybe use an ATR based stop, maybe use it kind of, but if you're trading this, you're probably going to have the sense to know, where's the stop go? Let me judge and adjust my position size to suit. And the fourth thing, personal thing, I'm not telling you how to manage your trade. I would never tell another man or woman how to trade, but for me, you've got to be ambitious. You know, if you are trading a true trap and the context is right, we saw some there which were valid, but you know, the volume was low, wasn't with the trend. We're not going to be so ambitious there, A to B only. If you're with the trend, the context is right, the volume, you've got a big trap, whatever that might be for you, be ambitious with your target. Say, you know what, I am on the end of something. I am one of the first on what I think is a lot of participants scrabbling and a lot of fresh participants seeing the others scrabbling, and I'm positioned. Don't touch it. That's the absolute thing where you sit on your hands and you do not meddle. Talk about not meddling with trades, but if you really grab something like that, you're like, I'm hanging on to this and I ain't getting out of the position. So a drill, what you could potentially do to kind of move forward this. Build your own playbook. How can traps go layer into your existing playbook? Like I said, I'm not here to say this must be do this, but if it's piqued your interest, you can like, okay, it makes sense. How could they play a part in the way I trade already? Label them up, open, label types, open, event-driven positioning. I think it should say intraday. Study your entry, add, stop positioning. Where would you perhaps trade it? And it often goes back to thinking, okay, well, if I saw that in real time, where would I want to position? How would I have to have the stop? It would have to be that wide, blah, blah, and maybe kind of do some screenshots and build your own kind of library of traps. So some takeaways: traps is kind of the crowd forced to act. If you're spotting rejection, you want to see the failure, confusion, panic, urgency, time sensitive rather than price sensitive. I think that equals opportunity. Want to wait for the confirmation of the trap failure. We're not guessing, otherwise it's just a rally. It's always just a short, 2 lows. It's a breakout. Like, you need that extra layer. It's like, okay, goes through this, does this, duration of time, comes back. Now the trap is set. You decide whether to act or not. And I think that gives you some good fuel for potentially big move. Okay, we've covered a lot of ground there, haven't we, boys and girls? We have. And I can see I like this kind of stuff. I think there's edge here. I think there's opportunity here. And I think that even though it's not something you're going to deploy every day, it's definitely something to have in your wheelhouse. You know, if you're a serious trader, which you are, because you showed up at 6 o'clock at night, to listen to me ramble on the markets, then ramble on about the markets, then you're probably pretty serious. But I think it's something that's worth considering. All right, so if you want to put your questions in, you can do. We're back again next week. We're still on the same theme, by the way, chart patterns decoded. What we're doing next week is we're going to kind of come through a way of wrapping this all up so that how we go from idea, whether it's a trap, whether it's a candlestick pattern, whatever it might be, to kind of building the trade up. So the stop placement, the target, how we define that, how we kind of get that raw idea and the kernel and the seed of a raw idea into actually an actionable setup. Because there's a difference between a direction prediction, an idea, and actually putting the rubber to the road and saying, well, how do I structure this trade? Should I wait for this to hit? Should I sell on this? Should I do that? So we're going to go through that, because I think that's the missing piece for a lot of traders, is the knowledge of what they want to see. And it's all very well looking at these back tested stuff and these patterns and going, yeah, it makes sense. But actually trading it with them, being able to manage the risk, being able to structure the trade effectively, and trying to get to the position where if you're wrong, fine, you're done, you've lost your 1 hour unit, you walk away, but you're not meddling in again and again and again, trying to take multiple bites of the cherry, or you're losing more than you want. So there's an extra layer that kind of comes into this stuff, which we will cover. Okay, we've got a little bit of time. Let me George Harrison, is there a chart to show? You said that earlier on, and hopefully you've seen the answer to that. George, there was some charts. Hi, Mark. Thanks so much for these webinars. They're great. Appreciate that, Robin. Let me click on that. There's some more. And then you said, only kidding. Hi, Mark. Thanks so much for the webinars. They're great. How do you confirm a trap is real and not just a retest? Do you go off structure alone, or do you need to see volume / order flow kick in? Yeah, you urgency. You want the urgency as well, Robin. I think that yeah, it could just retest. Absolutely, you could. And that's where you wait. That's where you kind of have your line in the sand and go, well, maybe if it takes back out the highs, I want to go. You notice in some of those chart examples, we're not selling a pullback, we're selling a complete reversal with the expectation that there could be more behind it. So we're not, this is why we have to be super patient. And most of the time, they're not going to do this. They're not going to do this. It's a very specific pattern that you're looking for. And again, we don't know for sure, but we want all the things that you probably look at, right? So the context of where price is relative to yesterday, the week, the kind of engine that's driving the market, the narrative, the story, the speed of execution, how quick, like that YM example just went boom. And we had sort of 6 or 7 solid 5-minute candles with huge volume off the lows. That's like, put yourself in the shoes of the man who just shorted that low and he's not got a stop in. Oh my God, I need to get out. So it's putting all these kind of pieces of the puzzle together. And of course, we don't know for sure, man. We can talk about this all day long and there's no certainty. And that's why maybe the next webinar will kind of add some color of, okay, well, we have the idea, we believe people are trapped. How do we express that? And how do we capitalize on that whilst minimizing our downside? And that's kind of the nuance of a trader, right? Robin says, this is Robin. Missed this one. Out of failed auctions, VWAP, flips, breakout stalls, which ones have you found give the most consistent RVR? I think it's when you've had, I know, well, from personal experience, maybe someone back tests loads of them and goes, you've missed all these. But from my perspective, I like ones that break at a key level. Like, okay, a VWAP stall is okay. It tries to bounce off. I'm not going to think, oh, loads of people are trapped there. It's a start of something that could build. And for me personally, I like to stack chips in. So I like to go, okay, I'll put a position on, I'll add to the position. If I've got an extended target, I can afford to do that. And so, I like to see the break of the low is probably the real trap. The VWAP fail is kind of, oh, there's some people trapped, but still half the participants don't care. But when we break through the low and we've got plenty of time, downside action and plenty of time of the day to go, I'm like, well, those people are stuck. So that adds more fuel to the fire. Robin's final thing on Robin, when you trade traps, do you always tuck your stop just behind the trap point, or do you sometimes give it more room depending on the context? That's a really good question, Robin. If it's a catalyst driven trap, i.e. a lot of, and this is kind of alluded to with the trend, if you get a lot of people positioning in one direction and then something's come out, the volatility spikes, right? And so you've got to be mindful of that and know that you are kind of trading with the trap, the whole panic, you're kind of capitalizing on that. They're the ones that are stuck. That generally normally will have a volatility expansion, and so you might have to have an initial position that's a little bit wider, because timing it, even though you can time it on the break and get the momentum, very often you get a fake, like you said before, that whips back on you. But if you really believe in the trap, you know it's got a lot of mileage, so you can afford to kind of go in smaller, maybe wider stop, and then if you're a pyramid type trader, as that kind of settles and starts to go in your direction, you can use the unrealized P&L to de-risk the trade. Hey, you're up, $50 on the Nasdaq, $50 move on the Nasdaq. Let's add some more, and it gives me 25. You can kind of structure it a little bit, and of course, it does depend on context. You're absolutely right. Gary Portugal says, very useful as always. Great topic. Cheers. Thank you, Gary. Appreciate your feedback as always, pal. You're always on here, and I appreciate you. And you, Rob. Thanks again for a great session. Rob says, appreciate that, pal. Mark Maguire says, great insights. Do you have a blog post on your site covering this type of strategy? Do I cover the traps? I've covered it. Do you know what? I might have got a dedicated trapped page. I actually don't think I have. Maybe I should expand on that. Maybe I should expand on it a little bit more. Thank you, Rob. Sorry, Mark. If you go into the trading strategy section, there may be some stuff, but I don't know if I've done a full top deep dive on that. But yeah, go to tradersmastermind.com, trading strategies or trading psychology. I'm kind of trying to get someone to tidy it all up, because there's a lot of stuff on there, and put the most valuable things that's sort of in the strategy section, so you can very quickly go, hey, I want to dig into VWAP a bit more. Let me do that. I want to dig into gap strategies, opening range breakout. So it's easier to kind of navigate, because it was a little bit of a mess before. Anthony says, great talk on webinar. Thank you. Appreciate you, Anthony. Do you ever use volume profiles to help determine areas of trap traders? I don't, but the logic makes sense. It's just one of those things I don't use. And there's nothing against it. To me, it makes absolute perfect sense. It makes perfect sense. And you're thinking on the correct lines, like, hey, there's a bunch of people here. Here's how much was done, and it's just a different way of obviously showing the kind of candlesticks. As much done was at this level. It's now this level. I think it would be an absolutely perfect way to do it if you kind of enjoy volume profile. So yeah, Anthony. Fuang, if I butchered your name, I may have done, mate. Apologies. How to spot a real trader who does real daily trading? You need to look beyond flashy claims and focus on logic, consistency, and real risk management. I appreciate that, pal. Yeah, you know what? The real world is, it's a little bit, there's a gray area there, and it's experience, right? As you know this, if you're working through, you start to go, hey, this is something I've observed. This is something that I think is valuable. It's not a textbook thing, but I've seen it. I think that I can layer this into my edge. Can I deploy this as part of a playbook? Should I be kind of running this system in parallel to see if there's some value here and some edge here? And I just try and share my experiences with you guys. So I do appreciate that, pal. Rob, quick one. Your opinion on gold? I don't know, mate. It keeps going up, doesn't it? We are overbought in the RSI. Personally, I don't think it can keep going up at this rate. Eventually, the buyers will sell and take their profit. We love your insights. I'm sure you've seen this numerous times in your trading history. Do you know what, Rob? I've learned this the hard way. Don't fight the trend. It may be overbought, but this thing can be overbought for another month, 2, 3, 4. You just don't know. And so if you are looking at it from a perspective of, I want to fade this, you might be right, but be clear about what you want to see. Be prepared to give up the first chunk and say, hey, if I'm trading counter trend, and it's a valid play, don't get me wrong, you don't have to jump on this long and blindly hope. You can say, I'm going to wait. What do you want to see? Do you want to see an exhaustion candle that might offer you an edge in? Do you want to see some kind of reversal? Do you want to see a double top, traditional type of thing? How do you want to play it? Do you want to dig into the positioning of commitment of traders? Do you want to kind of go down that rabbit hole and use that to layer in? But I think it's fine to not want to participate and think it's overbought. I don't think it's the right thing to do, just to blindly short an uptrend, because it just over time, you might get it right this time, but it's a strategy that you can't deploy over time. Very, very difficult to pinpoint, and very, very hard to judge when things are turning, Rob. So yeah, think carefully, play the game of chess of, okay, Rob, thinks it's too much, too high. Okay, what I want to see to actually initiate the trade here? What are the kind of different patterns that I'd like to see unfold that make me go, you know what, maybe that's worth a look? it ain't going to be just because it goes up X days in a row. And you might be right. You might be able to catch it and you go, oh, I'm a genius. But you're better off to be more strategic about it. Play the game of chess. Let someone else step in front, especially if you're trading counter trend, and then strike when you kind of see your pattern. I bet it's helped, Rob. Maybe Yasmin hasn't, pal. Beth says, thank you for the very useful webinar, Mark. Appreciate you, Beth. Recently, I've been focused on understanding where the liquidity zones are, where potential traps might form, and where the price is likely to move. Brilliant. 3 things to absolutely focus on and often lost. Where the price is likely to move. A target-based approach to trading is such a psychological hack. I think that when you have confidence in the target, time of day, price level, liquidity zone, whatever you want to call it, it's much easier for you to pull the trigger, hold the trade, sit through chop, sit through noise. Very, very powerful, I think. And exploring the logic behind price movements has helped me avoid many losses. Great news. Love to hear it. Trade. The unsexy side of trading is limiting the losers. The sexy side is, oh, look how much money I've made. Yeah, but if you limit your losers like you're doing, Beth, hey, if I can chop these down, get rid of the worst trades, that automatically goes to the bottom line as positive. So, everyone's focused on making all this money. It's like, well, actually, maybe I need to focus on. Maybe that's doing all right. But actually, if I can just eliminate the worst chunk of those losers by not taking maybe the substandard trades, not getting caught in stuff I don't want to do, that's automatically profit. Just by the nature of maths, right? So thank you, Beth. And I really love to hear that stuff's helping in a small way. I'm not saying that my stuff has changed things massively for you, but if it's a small contribution to the improvement of your trading, I feel like it's worth. Well, Alison says, thank you, Mark. Brilliant webinar. I appreciate that. Alison. Gary says, webinar topic suggestion. Oh, okay, Gary. Always interested to hear webinar topic suggestions. Dealing with parabolic markets like gold. Hey, you know what? That's not a bad idea. Come up with sort of ways to think of how you might short this if you were going to short it, what you look for, and how to structure the trade. Yeah, that's cool. Rob says, brilliant. Thanks. In answer to the question I said before, I think. Have I got everyone? Just a flash. Thomas says, thank you, sir. Appreciate you, Thomas. I appreciate everybody. Thank you for staying, listening to me ramble on about the markets. Hopefully you found it valuable. Hopefully you can take away a few nuggets that will help your trading. If that is the case, then I think it was an hour well spent. See you next week for the finale in the series, and we'll come up with something cool for the next time. But see you next week, guys. 6 o'clock Tuesday. Take care. Hope the government doesn't shut down there. All hell breaks loose. I don't think it will. Maybe it shuts down. I don't think all hell is going to break loose. Anyway, end of quarter today, end of month today. Just in case the final hour, there's some shenanigans. Just be careful as always. See you later, ladies and gents. Appreciate you all. Bye-bye.